Hello and welcome to this special edition of Money in Motion video blog. This is Dan Perkins. Today I want to talk about energy and energy prices, not only the commodity, but also energy stocks. As you know, we've had a significant position in energy, and we saw a significant decline in the value of the portfolio as energy collapsed in late 2015 and early 2016. Energy prices bottomed around $26.50 a barrel and now have returned to $46 to $48 a barrel, sometimes getting close to $50. I believe we're in a bottoming process here and that the next move is probably going to be up north of 50 to 55, maybe 57 between now and the end of the year. Now, the energy stocks underperformed the commodity. This is a very important chart which you're about to see. It shows the relationship to the price decline of the commodity, crude oil, to the energy sector as measured by the oil ETF. What it shows that clearly that the equities have sold off more than the commodity. And while the commodity has rebounded dramatically, almost 100% from its low, many of the commodity stocks, energy stocks, have begun to move, but are lagging the movement, the price movement in the commodity. So this is what I think is going to happen. As we turn into the second quarter earnings, I would expect to see that the earnings for the energy sector to be flat, maybe down just a little, but not down dramatically. As we go into the third quarter, when we get a full quarter of north of $45 a barrel, closer to 50, I would expect to see the earnings begin to rebound in the energy sector in the third quarter. And as the markets continue to hold in the $45 to $55 range, interest will begin to pick up in the undervalued sector and the undervalued basis for energy stocks. I look to see them to rebound. Now, it's not going to be overnight. It's going to take a while. It took a while for them to come down. It's going to take a while for them to recover. But I do believe that there is a possibility that we will begin to see significant recovery sometime at the end of the third or beginning of the fourth quarter. What's important is that this election will determine probably the direction of energy and the price of our stocks. If we get a Democrat, I suspect that there's going to be more controls on the production of energy, more emphasis on expensive alternative green energy, and less production of basic fossil fuel. So I expect, however, if we get a Republican as the winner of the presidential election, I would expect to see a significant rally in energy stocks because Mr. Trump is committed to having America be energy independent. And on that subject, let me help you understand what's going on in the world markets as it relates to us and energy. Cushing, Oklahoma is the delivery point for the commodity futures that trade in oil. And it's an indication of the surplus of oil in the United States. In addition, the number of rigs drilling for oil and natural gas in the United States is an indication of an interest. We currently have about 467 rigs in operation, down from about 1,800 a year ago. What's important is that we got 460 rigs drilling. Cushing, Oklahoma is almost at maximum capacity. Storage capacity all over the United States is extremely high, and storage of the commodity is extremely high. So what we have is a situation that we have a glut of inventory in the United States. Surplus of inventory in the United States to the point that we have shut in thousands of wells who have reserves in the ground but can't pump at these prices. And yet, on a daily basis, we are importing 4 million barrels of oil a day. That doesn't make sense to me. Why are we having our wells shut in when we can be, and we're importing 4 million barrels of foreign crude a day? It seems to me that one of the ways that we can stimulate our production is put a tariff on incoming crude oil. And maybe put in $10 or $15 a barrel coming in. That 4 million barrels is going to dry up relatively quickly because imported oil will be much more expensive than domestic oil. If we reduce our imports by 4 million barrels a day, we begin to burn off the supply that we have in inventory, and the wells that have been shut in can begin to start pumping again, which means we're going to put people back to work, we're going to generate revenue, and we're going to be able to export oil because we may have some of the lowest oil prices in the world. You see, I don't think Saudi Arabia and many of the Middle Eastern countries can take a $10 to $15 tariff in order to try and protect their market share in the United States. And if we can drive the Middle Eastern countries out of our supply chain and become totally independent of Middle Eastern oil, we're stronger economically and we're stronger from a national security standpoint. So I'm hopeful that energy prices will recover slowly, but I believe that our portfolio of equities will continue their recovery that they've already started. Now let me finish this with one other thought. Some of you have told me or asked me, so Dan, if our energy portfolio returns to what we paid for it or more, shouldn't we sell? Good question. But we must look at it in the context of where does it fit in an overall strategy. Right now, the yield on the 30-year Treasury bond in the United States is 2.25%. And the yield on the 10-year Treasury bond is 1.57. Now, your portfolios are yielding somewhere between 4 and 5%, considerably higher than the long and intermediate term Treasury market, and at the same time, predictable income, mostly coming from dividends. In the past, before they started cutting their dividends, energy stocks were high payers. And I believe they will be high payers again. The question that I have to wrestle with every day is, if I sell a stock that recovers, what do I do with the money? If I give up one level of income and replace it with what? Less income? Because you want less volatility? You know, I've been saying to some of my clients recently, you know, I've spoiled you at the yields that you've been earning on your portfolios for the last 10 years, being so much above the market, which has allowed you to take out a significant amount of money without having to evade principal to meet your needs for the most part. So the challenge that I have, as interest rates have continued to fall, and there's a possibility that, like many other countries in the world, interest rates on U.S. government debt may go negative, which means you're going to have a negative rate of return, and you're not going to have any cash flow to pay your bills in the Treasury market, then we have to look at alternatives. And when you look at alternatives, you have to look at risk, and when you look at risk, you look at volatility. You know, I've been increasing the positions in preferred stocks, but as we saw recently, some of those are being called away. So let me deal with an important issue here. Some people have suggested, okay, if oil prices recover to the point that our portfolio gets to be even or a little up, shouldn't we consider selling? And on the surface, it may sound like a reasonable question, but in reality, the question that I have to ask is, where do I go with the money? If you're used to paying your bills because we're generating 4 to 5% cash flow, almost twice the return on the long Treasury or 3 times the return on the short Treasury, then I have to go out and I have to get a return to compensate you. Where do I go? Well, common stocks aren't going to be that. I got to look at preferred stocks, and I got to look at alternative investments. I'm already in preferred stocks, and I'm already in alternative investments. My point is that I have grave concerns that we're going to have a slowdown and continue to slow down for a while. And depending upon who gets elected, it could be a long while or it could be a short while. The issue then becomes, what are rates going to be? I suspect if we get a Democratic president, we will not have a robust recovery. We'll probably have a recession in 2017, which means we're going to have probably negative interest rates, meaning that you're going to have to pay the government and you're going to lose money guaranteed. So trying to find alternatives, if we've come from down 100% to up to even, the momentum has been driving those prices higher. Why should we walk away from the momentum? I understand and appreciate, because I'm in the same boat that you're in, the volatility that energy stocks have created in our portfolios. But when they recover, where do we go? How do you pay your bills? I will do the best I can, but one of the things that's important for me to communicate to you, that as volatile as these markets are and as quickly as they change directions, is getting more and more difficult to try and figure out what to do with the money. And I work at it very hard, trying to find the best, most conservative, attractive, yield-paying investment that I can. I will continue to do that, but these times are becoming more and more difficult. If we reach a point of negative interest rates, I think many of the items we have in our portfolio will trade at a premium simply because they produce a much higher level of cash flow. So it's a difficult time. I hope this energy lesson has helped you see what's happened and understand that there is a really good possibility of recovery. But I'm also thinking about what are we going to do after the recovery and we get our money back, where are we going to go next? As always, should you have questions, please feel free to give me a call. This is Dan Perkins. Thanks for watching.